Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com tells us the transports are leading the industrials, and that could play a role in predicting future market action. InsideTrackTrading.com President Eric Hadik tells us about the cycles affecting gold. He also warns just a few high-performing stocks are masking what's really happening in the markets. Reporting from San Diego, Robert Campbell, publisher of the Campbell Real Estate Timing Letter, comments on what's happening in the hottest real estate markets. He believes Russia and China are buying all the gold they can to turn it into a monetized weapon. Plus, at the end of the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Ross Clark right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Media recognition from Bloomberg, Reuters, Recycling Trade Publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Reaugh, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. Welcome back to This Week in Money, Ross.
Always good to be with you, Jim.
How is gold doing right now?
Well, it's going through a consolidation phase here. We got that really good oversold readings in the middle of August. Started to see the commitment of traders numbers with the speculators going net short and the commercials on the verge of being net long in their positions. So, we were setting up for potential interim lows and a short covering rally. We've now seen some reasonable buoyancy as far as the gold market is concerned. For the better part now of about 4 weeks. Silver still got hit and has only started to bounce back in this most recent week. But the pattern we're looking at here is one that still probably has to walk its way lower over time. But in terms of where we sit in the sort of the 8-year cycle and the fact that we rolled over and broke significant support back in the springtime, and all the moving averages, the 200-day, the 150, all the big ones, we have been broken and we're underneath them at this point. So you need to be looking for an interim rally that puts us overbought, and that should be somewhere in the 1240 to 1250 range in gold. And gold this week finished off at just under 1200. And if we can get a good rally back into that 1240 to 1250, the weekly charts are going to give us an overbought reading. And with where we are in this downward trend that we've had now for the better part of 8 to 12 months or 8 to 10 months, that would be a time to be a seller. Now, in the very short term here, an interesting point, Tom McClellan pointed out that we've now had the last 6 months, the 15th of the month, has seen gold market get hit hard. It's as though there's one large seller out there with significant size has been able to push the market down. And this Friday was a prime example of that, down below 1200 after being up over 1210 into almost pushing 1220 in Wednesday and Thursday. What I'd like to see here and keep an eye on is with this selling that has been happening around the 15th, in most cases since April, there's been follow-through in the days to come. This one is now well above the low. We're a good $35 or so off the lows. And so if all we have is the selling that was on Friday, and maybe a little bit more in the early part of the week, that can set us up for that rally back towards the 20-week average in that 1240 to 1250 range. When we get there, I think investors in the gold market once again need to become very cautious, and we will be looking for probably lower lows as we move into the next couple of months from there. And we'll keep an eye on things such as the GDX, the Huey, which those broad indices in the gold market had some nice buy signals in the last week or so, enough to give us this bounce. But as I say, it should just be probably our best bounce from since April, but not have the ability to carry through.
Any action in the transports that we should be aware of?
Well, when you take a look at the old Dow theory, when you look at the industrials and the transports, and you want to see them both have new highs together to confirm that you are in an upward trend. And when you get a non-confirmation, generally it's looked at that when the transports can't match the move in the industrials, that shows that side of the economy is slowing, and that's considered to be a sell signal. We've had numerous of those ones going back, 100 years. What we don't see much of is when the transports lead to new highs, which is what we're seeing now, and the industrials are failing. Now, in the last 30 years, when I take a look back, there have been 9 examples of this, and 7 of those 9 had some pretty good corrections in the ensuing months. So with us sitting right now in a seasonal period, I think we talked about this in the last week, where the early part of September, usually that first 10 to 15 days, produces an important low as far as the S&P or Dow is concerned. And if that supporting low is taken out, then you look for the seasonal pressures to carry you to either the end of September or that mid-October to early November window. So right now, with the divergence we're seeing in the transports and industrials, if this rally tires out and starts to take out the supports that we had back on the 7th of September, a week ago, I would suggest that traders look to move to the sidelines in anticipation of a much better buying opportunity as we move into October, November.
Ross, thank you so much for being on the show.
Nice to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Coming up, Eric Hadik from InsideTrack.com next on This Week in Money.
Always consult your investment professional before making any investment decision.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineered gold mine in the Atlan district of northwestern BC. Check us out at blindcreekresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Eric Hadik, president of InsideTrack.com and InsideTrackTrading.com. Welcome back to the show, Eric.
Oh, thanks for having me back, Jim.
You have a long-range forecast for gold and copper. Can you tell us about it?
Well, one of the things that I think we were talking about a little earlier is the 1 to 2 year outlook for gold stocks. And so often when I'm discussing gold, listeners or readers want to immediately apply it to gold stocks and vice versa. And often that can be the most dangerous thing to do because they do trade on their own fundamentals. Obviously, gold is one of those, but it's the only one when it comes to the price of gold, whereas sometimes it's just a minor factor when it comes to the price of miners and gold stocks. But with all that said, in late 2016, there was a very significant trend signal in my work in the XAU index, and that showed me that we would see a couple-month bounce, and then from that point forward work down towards below the December 2016 lows, and ultimately a lot of wave and other price targets were pinpointing 54 to 59 in the XAU index as the ultimate downside target. And it took a lot longer to get back down to that December 16 low than a lot of people expected, but it finally reached that in the last couple months, dropping to new lows below that low. And now we are just approaching that primary downside target of 54 to 59. And so we're getting into a time frame and a price range where there's a much better chance for a significant 6 to 12 month bottom in gold stocks and in the XAU index, and that's even corroborated by a lot of cycles coming into play here.
What are the cycles telling you? Where are we in those?
Well, one of the most consistent cycles that I've seen in the XAU index is an approximate 32-month cycle, and that sometimes that contracts to 31 months. It has expanded to 33, 34 months. But when you're talking about an almost 3-year cycle, that's to be expected. I don't expect cycles to be perfect or precise down to a day when you're talking about something like that. But if you go back, even to 2005 and then to 2008, in March of 2008, we saw a significant high in the XAU, and then in late 2010, another high, and then the cycle inverted to a low 30 months later in June of 2013, and then in January of 2016, 31 months later, you saw another low. And ever since that low, that's been telling me to look for a subsequent low that would probably be above the January 2016 major bottom. Most likely in the third quarter of 2018, where we are right now. And so 32 months from that January 2016 bottom puts us into September of 2018. So really September 2018 plus or minus a month is the ideal time for a bottom in that index. There are some a little bit more current cycles, not quite as long-term as that could stretch a final spike down into November, but it's all within that September to November time frame, and that's where price action is what I rely on at that point. The cycles give me a general foundation or backdrop to know when to look for more significant price action and reversal signals, and then it's up to that price action to really dictate when a low is intact.
Eric, I know you rely on cycles for your prognostications, but geopolitical events used to affect the price of gold, but have you found that your charts have nothing to do with that?
Well, one of the things that I try to emphasize, because in one form or another, this conversation and that hypothesis that you just postulated comes up again and again. And when you talk about trying to pinpoint one item, one event that has the closest correlation to gold, to me it is the faith or the stability of fiat currency. And the reason I say that instead of just the dollar, because there have been times even when the euro is kind of in more of a panic selling mode, even a little bit with the yen, where that has driven some money into gold. Yes, in many cases it is the dollar, and since we're talking about gold priced in dollars, there's an inherent inverse correlation there right from the start. But when you're comparing it to something like the dollar index, which is a basket of currencies, that inverse correlation begins to kind of get muddied a bit. And so I've seen the most consistent movement, especially to the upside in gold, when there was more of a concern about one of the primary currencies. And of late, they've really been, gold had a little bit of a rally the first 6 months of 2017 when the dollar started selling off sharply. But since then, the ebb and flow of the dollar and of the euro and even the yen has been within a confined range, a range of normalcy, and so gold has really just been mired in complacency and slowly selling off. With geopolitical events, and it used to be okay, anything that looks like war or conflict is good for gold. That correlation has been very inconsistent at best. And then there's the argument of inflation, deflation. That one too, except during the real throes of one or the other. It doesn't have as consistent or reliable of a correlation, and that really ties into an axiom that I often repeat to my readers, and the gist of it is when you're looking for those one-to-one correlations or those pretty consistent and reliable correlations, they usually only occur when the lead market, whatever that is at the time, is in more of an extreme phase, perhaps a parabolic move or a very accelerated move or breaking to new 20-year, 30-year highs or lows. That's when you'll get a lagging correlated market move in lockstep with that lead market. But all the other time, which is the majority of the time, which, is 80 to 90% of the time often, those correlations will separate, they'll delink, and then each of the two markets in question, like the dollar and gold, if you're looking for gold to go down when the dollar goes up, or vice versa, it's only when the dollar, the lead market, is in an extreme phase. Any other time, there's a lot of divergent and differentiated fundamentals that are impacting each of those markets independently and driving them in their own direction. Sometimes they'll be rallying in lockstep, one with the other, and other times they'll be trading it at complete inverse correlation. But so all that to say is, I think that trying to trade off of a predetermined correlation can be very dangerous, and it doesn't really give you a place to assess risk, to assess where you're wrong. I mean, really, the most important thing for me when I'm doing any analysis or generating any trading strategies is where will it be wrong? Where do I need to get out and say, oops, this was not, either this was early or something was not anticipated here. And when you're trading on something like those correlations, there's a lot more leeway and a lot greater risk that you have to undertake.
We'll have more with Eric Hadik next on This Week in Money.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE symbol CRL and the pink symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
I'm Kelly Jennings, CEO of PowerBand Solutions. PowerBand is a cloud-based provider of auction, inventory, and finance solutions that make buying, selling, and financing vehicles more efficient. PowerBand Solutions trades on the TSX Venture Exchange symbol PBX and on the OTCQB symbol PWWPF and on Frankfurt symbol 1ZV. For more information, please visit us at powerbandsolutions.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Eric Hadik. Eric, have the major stock markets in North America peaked, or do they still have room to grow?
I am still looking at 2018 as being a topping process where we would see a sequence of highs and where you look at a lot of the individual stocks and even some of the primary indexes that have not exceeded their January highs, even though those 3 to 6 stocks, starting with Amazon, Microsoft, and it was Netflix up until a month or so ago, had accounted for 70 to 80% of the intra-year gains in not only in the NASDAQ, but in the S&P 500 as well. So that kind of masks a little bit more vulnerable topping process that is going on in a lot of other stocks and a lot of other indexes. But that's not to say that a major top is intact or that a collapse is imminent. I do think that we are going to see a multi-week correction into October, and in some indexes there's signs that the peak associated with that is already intact. In others, there's still some ambiguity as to whether those indexes will retest their recent highs, spike a little bit above them. But once I see a couple of indicators corroborate that and turn down, then that will give me a much better indication of how the magnitude of this correction that I would expect. But when I look at recurring, more significant drops, I don't even want to use the term crash, although because that's often so or distorted, I should say. But a sharp sell-off and recurring cycles of that, I'm looking at third quarter of 2019 for something a little bit more like that. So between now and then, we could certainly be seeing more of a topping process and maybe some initial sell-offs, but there's nothing yet to say that a final peak is intact yet.
Traditionally, are September and October the most dangerous times of the year for the stock market?
They are certainly one of them, and yes, you can also look at that in two ways. You've seen some of your sharpest sell-offs, even going back into late August through mid-October, and October has also provided some of the most significant bottoms of bull markets going forward.
Taking a look at what's happening with crude, what do you see happening there?
Crude has really adhered to some pretty consistent weekly and monthly cycles that were anticipating a pretty big rally in the second half of 2017, an initial peak in late January or early February of 2018, and then a pair of subsequent highs in mid to late May and then late August, early September of 2018. And particularly crude has really held to that outlook, and it has had some very revealing indicators triggered that, particularly this last peak, really were indicative of a top already in place and a sharp decline expected throughout the month of September, and I still anticipate that. We just had a little bit of a quick 2-day rally back towards the highs. I think it was as much on Hurricane Florence fears, but even that rally has just retested the highs, has not turned any indicators up. So I think that that's going to quickly give way to new selling, and I'm looking for an initial low a little bit after mid-month, but then a final low stretching into October, and it could be significantly lower in crude.
I know it seems every fall the U.S. gets hit somewhere with hurricanes, and in British Columbia for 2 years now we've had severe forest fires that have cut the supply of lumber. Do you see any increase in lumber prices?
Lumber has broken below some pretty critical longer-term support for me, right around the $400 level. So at least on the 2 to 3 month outlook, it's remaining weak. It hasn't given any signs of a multi-month bottom forming, so at least right now I don't see that.
We'll have more with Eric Hadik right after the break.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink's CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp, MGI, and the TSX Venture Exchange. A 2015 drill program on the LH property intersected several high-grade gold intersections, including 11 meters of 20.66 grams per ton gold. Additional drill targets on the LH property have been identified by a 2018 drone airborne magnetic survey to further evaluate a pyrrhotite-enriched gold-bearing system. Please visit our website at magnumgoldcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Eric Hadik. Eric, we're seeing various interest rate policies around the planet. The Fed saying it's likely going to hike rates at least a couple of more times. The European Central Bank just announcing recently that it's going to keep its rates exactly the same at least through next summer. The Bank of England and the Banks of Canada both saying they have no plans to hike interest rates right now. What's your outlook on interest rates?
I'm viewing them from a little bit broader perspective, as opposed to just, where bonds and notes could be going the next few weeks or next month or two. And my scenario continues to be a bear market from middle of 2016, which was the convergence of a lot of multi-decade cycles, but seeing interest rates peak then and work lower on balance into the second half of 2019. Coming into this year, I thought we would see a little bit more of an uptick in the rates into mid-year, and then a lot of consolidation until we get into 2019, and then see one more move up in interest rates, U.S. interest rates. So that still is the broad general pattern that I'm looking at, and haven't seen much to contradict that up to this point.
Seeing as how money flows around the planet very easily, could this see the U.S. attract a lot of investment just simply because you could make more on your bank account?
I think it could have, but I think that a lot of what you're discussing is already priced into the markets. And that's another thing that I think sometimes at least newer or more novice traders or investors miss, and that's the fact that today's fundamentals were usually already priced into the market a month ago, 3 months ago, 6 months ago, depending on how big of a fundamental you're talking about. And so I think that a decent percentage of the selling in bonds and notes has anticipated that, and the dollar strength of this year has factored in some of that. So then you kind of look at what could be a little bit of a surprise or a contrast to that. And, you know, that might be if somewhere like Europe were to 6 months from now start to look like things are better, and maybe we can start talking about reversing from all the easing and start to tighten a little all of a sudden. That would be the type of thing, because it's against what has been factored into the market, that would have more of an impact than just kind of reaffirming what's already on the table where U.S. rates are concerned.
Cryptocurrencies, are they going to stick around?
I think they're going to stick around. The big question is when something like Bitcoin can manage to muster up another rally, and that could still be a little bit out on the horizon.
Is that something that you watch, Bitcoin or other cryptos?
Bitcoin I do watch, and I continue to focus on major support at between 5,500 and 5,800. That was the downside targets that I published back in December and January, that I thought would be kind of the culmination of a bubble bursting, and that then you do have a period of licking the wounds and starting to build a new base, and that takes time. In many respects, on a little bit tighter time frame, it's kind of like the dot-com bubble of the early 2000s, where, yes, the internet was still going to be around after that, and it was still the wave of the future, but the prices had gotten so overvalued and then, collapsed, and it took quite some time to really begin to build enough of a base to be able to sustain a more significant advance.
Eric, is there anything that really catches your eye right now that you think could be a good investment due to cycles?
Really, I am looking at the precious metals arena. If they give a stronger indication of a bottom within the next few weeks, then I think it may be time to start putting at least a percentage of a portfolio into them, and that doesn't mean that I'm expecting some parabolic move to the upside, and that's something I almost always have to clarify, because as soon as you start talking bullishly about gold, then everyone wants to take that and add some hyperbole to it, and all of a sudden it makes it sound like you're talking that it's going to the moon. I'm not thinking that, but I think there could be a decent 1 to 2 year return once a bottom is confirmed there.
Eric, before we go, could you tell us a little bit about Inside Track and how some people can get more information about it?
Well, the best way is to go to our websites, and currently, because we are updating and just slightly tweaking that, we've got InsideTrackTrading.com and InsideTrack.com. Both of those have the extra I in the middle of inside, so INSIIDE. And that's really where you can find a great deal of sample publications, of information on our different subscriptions, and anything that we offer.
Eric, thank you so much for being on This Week in Money.
Thanks for having me back, Jim.
My guest has been Eric Hadik, president of InsideTrack.com and InsideTrackTrading.com. He was speaking to us from the Chicago area. Coming up, Robert Campbell, the publisher of the Campbell Real Estate Timing Letter. Next on This Week in Money.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and planned for Canada this summer. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm speaking with Robert Campbell, author of Timing the Real Estate Market and the Campbell Real Estate Timing Letter. You can find him online at realestatetiming.com. Bob, welcome back to This Week in Money.
Thank you very much. We got a lot of fun things to talk about today, Jim.
Does the U.S. still have any really hot real estate markets?
Yeah, I would say so. I'd say there's some hot markets. Las Vegas is hot. Las Vegas is hot. It's the hottest major market here in the United States. And what's interesting, that thing has really rocketed off the bottom after the 2006 peak. It had a super crash, and off that bottom, it's up on average I believe over 100%. And what's nice about that is that they're about 15% away from getting back to break even where they were 12 years ago. That shows you what that real estate cycle's like. How much of that do you want, Jim, in your portfolio?
Well, I saw $600,000 condos fall down to $60,000, so.
Look at that. That's the kind of volatility that, and Las Vegas is a major market. And there's other cities that, that's the worst, but, Phoenix, the California markets, Miami, they all had similar falls, just not quite the extent. And when you start coming off the bottom 100% off the bottom, and you are still 15% to 20% away from break even, that kind of makes you stop and go, whoa, that's some kind of roller coaster.
Are there any places where things are falling apart?
Not yet. Not yet. The first place I think is going to go, it's going to be Chicago. Chicago's right on the edge. Chicago's got the worst problems of anybody. Their finances are the worst. Their pension crisis is the worst. They have a total socialistic government. More people are murdered there than anywhere else. And 1 million people exited the state. 1 million more people left the state of Illinois last year than came in. And it's, what it's kind of reminded me of? It's kind of reminded me of what happened to Detroit. But it's going to be the first U.S. major city to by my indicators, to produce a sell signal.
Are inventories of homes for sale growing in the U.S.?
Yeah, they finally start growing a little bit. Maybe in some areas more than a little bit, but on average, it's a little bit. In fact, the inventory of homes on the market, it was in a very pronounced 3 to 4 year downtrend, and the latest numbers actually are making, took out some of the old highs where we're going back. They're making, highs, numbers that we haven't seen in a couple of years. So I would say that there's a real good chance that that trend is reversed, and now we're going to see more supply coming on the market.
Are sales of homes in the U.S. increasing or decreasing?
Slightly decreasing on a year-over-year basis. There's another weakening market internal that you need to follow for tracking real estate trends. I think the year-over-year figures have been down 4 out of the last 5 months. It hasn't crashed yet. It's only down year-over-year right now, maybe, 1% or 2, but it's still down. The key is down. You know, all of a sudden inventory is starting to come up. Sales are going down. Therefore, the warning signs. I mean, you don't have to panic yet, but, you know, you better be standing, close to getting out of this. Have a way close to the door when it's time to leave, if that's your strategy. And that probably should be your strategy in a lot of places in the United States.
Are rising interest rates the key to all this?
Rising interest rates, that's not my biggest concern. And historically speaking, it's never been the biggest concern. They're certainly not helping. But when you start piling stuff on, like rising inventory, declining sales, the number of, and other key indicators that I watch, and then and the third key indicator, of course, is interest rates. Slowly it all starts adding up until, the dam breaks. I mean, it's in a negative trend too. So but it isn't really bad yet. But, where you decide what's bad and, where that line is drawn is always, the only way you can tell is wait for the indicators to tell you that. The people that are, participating in the market going, hey, I'm not buying. And of course that's trackable, and that's one of the key indicators, signs I use for, saying, the uptrend's over and the downtrend is now starting.
Does it look like interest rates will continue to rise?
I think so. Yeah, I think they're going to keep rising, Jim. I mean, that's just kind of an educated guess. But it's, I would put 60 to 70% odds on that.
When banks constrict mortgage credit, does it cause prices to go lower, which then causes the banks to further constrict credit?
The availability of credit is really an interesting subject because banks will quit lending money until prices get will continue lending money until prices get so extreme. They will lend right up to that point. They won't. Prices get so extreme, and then all of a sudden, the next month or two of borrowers, mortgage applicants that come through, they can't even meet the standards, so they get rejected. Now that's how credit stops. It's not done consciously. It's just done by these formulas, and they reach that limit, and all of a sudden, that restricts the demand too, because there's less buyers in the marketplace. But we haven't, I read somewhere that mortgage applications are down to 2,000-year lows. I mean, to the lows hit in 2000. So of course that's 18 years ago. But those mortgage applications include refis and things like that. And, as far as, predicting, which way the markets are going to go, in the major turns, that's not an important metric to follow, refis. So I don't use that. I think people misuse that indicator, in a big way as far as its significance.
We'll have more with Robert Campbell when This Week in Money returns.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Robert Campbell. Bob, are Americans deeply in debt?
Yes, they are. Yeah, they never got out of debt in a meaningful way, for one thing. I mean, they haven't increased their indebtedness to the degree the U.S. government has. They've violated the debt rules more than anybody. They've gone more deeply in debt than the average American, but he's still deeply in debt. There's no question about it. He never got out of debt. I mean, there's that's one of the reasons that they dropped interest rates so low. If people can't make enough money to buy things, based on their income, with normal means, and they can't save enough money, give them cheap credit to keep their consumption continuing and supporting the economy, and to a pretty significant degree, that's what they've done. Cheap credit. Now, car loans. Is there any interest rate on car loans? No. I mean, what if we went back to the old days where car loans used to cost you like 5 or 6%. Do you think that would change the demand for cars? Yeah.
Do you think it's a warning sign when people have to start buying groceries with their credit card?
I don't know. I don't know if that's true or not, or it's a matter of convenience. It may just be convenient. I mean, I do everything with my credit card with for the sake of convenience, Jim, but I pay it off every month.
Or if you have a cashback card, you make a little money.
Oh, yeah, that's the business opportunity I'm going to pursue. Is that the more you spend, the more you make?
Well, you get back 1 or 2%. It's better than a sharp stick in the eye.
Yeah, but you're still buying stuff on credit that you can't afford.
Yeah, but then again, if you pay it back, you get a bonus at the end of the year.
But I think the point I'm trying to make is that it's the way of the world. I mean, the way the world is, everybody nowadays, for convenience, go fast. It's on their phone, or they have a credit card, or any of that kind of stuff. A lot of it's convenience. The credit card balances, I think they've gone up a little, and they've stayed elevated, but it's been nothing extreme. To a large degree, the average American, Jim, learned their lesson from the last downfall. If you go back, to the year 2006, which was the peak of the housing market, peak net worth for all Americans, because the average American, they don't own stocks. Most of their net worth, whatever it is in their homes. Their peak net worth is 2006. Okay, let's fast forward to 2016, where real estate prices on a national basis are probably, close to break even to where they were in 2006. In other words, they're close to kicking out the old peak. You might think that the average American, 90% of all Americans, would have their net worth elevated to where it was back in 2006. However, that's not the case. It's down, the average guy is down about 30%. Isn't that amazing? 10 years later, your net worth's down 2%, and although real estate prices, which caused them the biggest losses, have recovered back to their old peaks. So in other words, that financial crisis hit people in a lot harder way than a lot of people realize. It wasn't just asset prices. It impacted their lives. Every aspect of their lives. I mean, to have a net worth that's 30% lower, today than it was 10 or 12 years ago, that's pretty bad.
Is the Trump economy helping the people of America from the poor to the rich?
I think so. I don't know. In general, yes. You know what? It's making them optimistic. I mean, the business optimism index under Trump is it's at an all-time record high right now. So people feel good. People are spending money. They feel good. Whether this is a sugar high or whatever, who knows? But Americans are feeling pretty good about their finances right now.
We'll have more with Robert Campbell right after this.
Hadik Ventures Corp. is a potash exploration company focused on the Korat Basin in Thailand, the world's largest undeveloped potash resource. Hadik's management has extensive potash exploration and development experience in Thailand. Hadik will have marketing advantage compared to Western producers. Drill program commences this spring. Hadik trades on the TSX Venture, symbol VCV, and on Frankfurt, symbol V8V2. Visit our website, hadikventures.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back to This Week in Money. We're speaking with Robert Campbell. Robert, is the U.S. dollar gaining strength because it's considered to be the safe haven currency?
Yeah, that's a terrific question. And I believe the answer is yes. It's a safe haven not only, if you look at, like, for example, the stock markets in the world and the Asian stock markets, China in particular, or Europe, our stock market, the U.S. stock market is outperforming those stock markets by a big margin. And with the problems these other countries are having, the euro problems, the problems in Europe just keep getting a little worse and a little worse. So what money's doing is it's capital flight out of these areas and into American assets. And, to buy U.S. stocks, you have to own U.S. dollars. And that's pushing the dollar up. And with rising interest rates, rising interest rates go hand in hand with that, upward movement in the dollar. So it's, the trend of the dollar is clearly up.
Mm-hmm. Well, taking a look at worldwide interest rates, the Bank of England, the banks of Canada, not raising rates. The European Central Bank says it's not going to raise rates or change interest rates at least for a year. What does that say about the U.S. Fed and its plan to increase rates? Is that just going to boost the U.S. dollar more?
Yeah, it is. Of course it is. Now the fact that they're not raising rates, that tells a story to anybody with a brain, as well, though. You can see that, keeping interest rates pegged down there at those low levels, the reason it's done is that everything's weak. That could even be the trigger that, that sets off the next huge worldwide, financial crisis if it's coming our way. And it's that, is the dollar, is the foreign debt. Most of these big foreign countries, all the BRIC, not so much the BRIC, but, the South American, the Brazil, the Argentinas, and a lot of other countries in the world, they're all, when they go into debt, they go into debt via U.S. dollars, not, their own currency, which is more volatile and more expensive. They go U.S. dollars. So when the U.S. dollar starts appreciating against their currency, that debt becomes more expensive. And that's what we're seeing right now, Jim.
Gold and silver are showing some signs of bottoming. What do you see ahead for gold and silver?
I'm not a gold timer. I time stock markets. I time real estate markets. I don't time gold and silver. One, it's the most volatile of all things to time. And two, I think that should just be a long-term position that you continue, that you own a significant portion of your wealth in gold in particular and some in silver over the course of time. And it's your long-term financial survival, the protection against that. And it hasn't been doing well lately, of course. The trend is down. The trend is down. What else do you need to know? The trend is down, and it's still down. I can't see a year to the future any more than anybody else. But I'll tell you, with the risk there, what the risk is that, or I think where the opportunity is, I think commodities, I've seen charts that show commodities, which include gold, to be likely to outperform the stock market in over the course of the next 5 years. And the commodities are so cheap right now, I think that's the place for smart money. And I think in 5 years you'll be so glad that you put your money in commodities, because commodities are very cyclical and they go contrary to the U.S. equity markets, for one thing, and gold and silver. So if we have another financial crisis and it just gets out of hand and, the U.S. Fed, can't buy another, $10 trillion worth of U.S. debt securities or $5 trillion or assets to support the market, because that would lead to a panic in confidence. They may just do the easy thing, which is to revalue gold at, $10,000, $20,000 an ounce or something like that to back the debt. And now we're back to normal. We got the debt, but at least we don't have a currency crisis. I think that time is coming, Jim. Sometime in the next, I don't want to say it's going to happen. I thought it would have happened earlier, but sometime within the next 5 to 10 years, you're going to see that, and you're going to see gold. You're going to see gold go to levels that are just going to knock your socks off. And if you're there holding it and you have it long term, sell half of it, and you're rich. You're rich for a long time. That's the kind of asset. And in the meantime, if you just own it and it doesn't go shoot way up like that, it feels good. You know why, Jim? Because it's money. Gold is money. You can take that gold coin down to a coin store anywhere in the world and get currency for it immediately, whatever the price is. There's not a lot of things. You can do that in the stock market if it stays liquid, if they don't close the exchanges, or most people don't own stocks, but there's a lot of safety. So I have always been a big advocate of gold, owning gold, from a financial security standpoint.
Do you prefer physical gold and silver over mining stocks?
Absolutely. The mining stocks are more volatile, And, you know, I haven't looked at the charts lately, but I think I've read a few headlines that the physical metal has held up better than the stocks. And they've been beat down. People have lost a lot of money in that kind of stuff, you know, if they were forced to sell. I like the physical aspect of it, you know, where if it gets really desperate, you can load those gold coins in the trunk of your high performance Mustang and get out of town. At least that's the theory.
The Dow has not reached another high this year, although the S&P 500, NASDAQ, and Russell 2000 have hit new highs. Is the Dow likely to follow those trends?
Yes, absolutely. And that's another thing. Why does we talked about that, or at least alluded to it previously, that the U.S. stock market is benefiting by capital inflows of flight capital from Europe and other places. They'd rather be in the U.S. They'd rather be in the U.S. dollar than the euro. You know, therefore that's one of or the U.S. markets instead of the stock market, instead of the euro stock markets, European stock markets. So you're definitely seeing that. You know, and that's something that's happened over and over again, where flight capital goes from one place to another place to another place. But that's hot money. That can change, Jim. That's not permanent money. Nothing's permanent.
Are you watching the oil market?
No, I'm not. Not really. I trade the oil market once in a while. I trade the market to stay sharp, and that short-term trader. You know, I'm in the market 1 to 5 days. I buy trend retracements, and I've bought oil a few times recently, but I can't recall making any money this year. I made money in it before, but it just seems to be kind of going sideways. You know, it's not up big and it's not down big. Actually, 3 years ago it was prices are about 10-15% away, lower than they were 3 years ago. So, to me it looks like it's trendless right now.
What sectors are you currently watching?
Well, I like the U.S. stock. I like the U.S. security markets a lot. I was interested in technology. I don't like technology so much anymore because it just doesn't seem to want to bounce. But it's basically the U.S. indexes because they are clearly up. You know, the Russell 2000, the S&P 500, the NASDAQ's at record highs, the Dow, those are all trends, those are the markets you want to jump on board on weakness.
Is President Trump using tariffs as a trade weapon to level the playing field and usher in real free trade and fair trade?
I think he probably believes that. However, I think that, I think it's probably what he's doing is a net negative, but what it's doing for the country, for most people, I think it's a net positive, at least how they perceive it, like jobs coming back to the United States. So I really don't see that as being, like a major trade war. I guess that could precipitate, some kind of panic in the markets, but I don't see that as being the biggest risk out there. I'll tell you, what I see as the biggest risk is rising interest rates in the United States. I mean, paying for all this debt, especially the U.S. government. I mean, when we go in, we're not that far away from a inverted yield curve, which, is the most reliable indicator of a coming recession. And if we have a recession and the Fed's got to drop interest rates to get things going and the Fed's got to start buying up assets, I mean, these deficits are going to get huge. They're going to go from $1 trillion to $2 trillion. And so I think probably the biggest threat to the global economic system is a currency crisis. It's all because there's debt. The debt can't be supported with anything tangible, and that's why I think that most likely I would expect them to revalue gold. I'm surprised Russia hasn't revalued gold or, all of a sudden, because they're having some hard times over there with their currency relative to the dollar. They've got enough gold, just back the ruble by 20% gold. The value of that thing would probably, shoot up 50% overnight. People rush to that for the safety of that currency, anything that has anything real behind it.
Is that why Russia and China have been buying up all the physical gold they can?
Makes you wonder, doesn't it? I mean, it's what I think. I think they know it's real wealth. I think of course, that's kind of an Asian thing anyway, gold and silver. But I think they know it's real wealth. Those guys aren't stupid, and they figure that what they're going to do is, at some point in time, they want to, China especially wants to be the dominant world power. They're going to use that gold as a sign of strength, and it is a sign of strength when you have gold. The people that have that gold, and I think I don't know what their plan is, to be honest with you, but they have some kind of plan or they wouldn't be buying. Nobody even knows that's another thing. Does anybody really know how much gold China has purchased in the last 10, 15 years? No. I mean, the speculations range from, they hold 4,000 tons up to they hold 24,000 tons. I mean, so who knows how much of that stuff they have, but I definitely think it could be used as an economic weapon, definitely in the time of turmoil, to protect your currency, because all the money would want to flow in that currency, to protect its value. And now all of a sudden, there you go. China's the winner, or Russia's the winner in that kind of thing. But I think it's a good asset to have all around. I've always been interested in gold. I could be 100% wrong about all of this, of course, but I don't think so.
Are the U.S. midterm elections likely to produce a wave of Democrats or Republicans?
I don't follow it that closely because I follow what people are doing versus whether the Republicans or the Democrats are in office and who has the most power, because it gets reflected in the indicators that I follow, so I don't have to follow that. But it's from my sense of it is the Democrats are going to take over the House or something like that, and then they're going to immediately start impeachment. But I don't know. You know what? I bet. I'm not a gambler, but I bet heavily on Trump for a lot of reasons that he was going to win. $20 bets with my friends. It gave me 5-1 odds. And don't underestimate what the people of the United States are really thinking right now. You know what I mean? So I think they like this message. Trump's out there with this message. I think it's a net positive for the average American, and it wouldn't surprise me if they vote Republican, because they really do. They like Trump better than anything else.
At a recent rally, President Trump said he has fixed Dodd-Frank but didn't give any details. What changes would you like to see to Dodd-Frank?
Well, first, the original Dodd-Frank, if there's one change I'd like to have, the original Dodd-Frank had the provision in it that under no circumstances would the U.S. government bail out the U.S. banking system in time of crisis. About 3 or 4 years later, that got kind of silently but absolutely reversed, because they knew that was just too big a risk to take for the bankers, the banking industry, the banking cartel that has all the money and all the power. And so I would reverse that back. We'll say, you guys don't get a dime. Wells Fargo, I was just reading the other day, because it's in the news about the financial crisis. Wells Fargo got $24 billion bailout. That's one of Warren Buffett's gem companies, that he owns. Got $24 billion bucks. And just say, no, let them fail. In other words, back to capitalism. That's what I would do. I know they're not going to do that, and that's why just things are going to get a little worse and a little worse and a little worse all the time with more and more debt and things backing everybody up, and more inflation and higher interest rates and that kind of thing. And that's what'll break the camel's back eventually. But that's what I'd like to see replaced with Dodd-Frank. The whole thing was kind of why do they even do that? To me, it wasn't even that meaningful. You know what it was? It was more of a show. Hey, we're really on top of things, the U.S. politicians, so we're going to create this bill that's going to protect the Americans, from that ever happening again. 95% of it, in my view, was BS.
Bob, if there was any single message you'd like to give to investors today who want to make sure they don't lose anything if there's a market crash, what would you tell them?
First and foremost, I tell all investors, first and foremost, play defense. Always have your butt covered. Don't lose money. So you should always be on the defensive, to get out of falling trends and into rising trends, whatever they are, because nobody knows how severe the next market downturn is going to be. And if you have the ability to take profits or just to, take your profits and get back into a safe position, do it. And I've been studying the markets ever since I was in high school, and that goes back more than 50 years. The people that and this has been an interest with me for 50 straight years, the people that do the best are the people that focus on defense, not offense, Jim. Is that what the average investor does? Is he focusing on defense, or does he have dollar signs in his eye about how much money he's going to make all the time? It's the dollar signs. And you know what? That's the biggest mistake investors can make. And I'd say, if for example, here in the United States, San Francisco housing prices went up 300% in 6 years, and now it's starting to get a little dicey up there. I tell them, and I wrote this in my last timing letter. When it's time to get out, get out. Because I think housing prices, using reversion to the mean techniques and other, things that are implied, where it's not just a wild guess that I'm making. I think housing prices in San Francisco to get back to the normal trend is going to be, in the vicinity of 30 to 40%. That's a big loss. Don't eat that loss. Not only is it money, it's your life. Losing money sucks. It makes every aspect of your life worse than it was before. So that's always been my emphasis, slow and steady. Don't get hit. Don't get hit. Always have plan B. When you got to get defensive, it's like General Patton. He's an offensive guy. But when things start going his way, does he have plan B defense? You're damn right he's got plan B defense. Save your troops. So save your capital. Save your life. Don't just sit there and go, I think this correction is going to be real mild this time. That's what I'm reading. These guys don't know how big or small the correction is going to be. You're just rolling the dice. You're spinning the wheel on the pistol with one bullet in the chamber. And all of a sudden you say, I'll take that chance. And I go, boom, all of a sudden you're safe and you made 10 grand. You go, wow, that's pretty easy money. Let's do it again. Boom, I made another 10 grand. Hey, I think this is, all of a sudden your risk levels go way down till the next time you blow your brains out. That's what most people do. That's been my experience. And I'd say, don't let that happen to you. Play defense. Play defense. Make your money when you can, but then when the trends turn, when the times are right, don't be afraid to take profits and exit the market and go to the sidelines, because like Warren Buffett says, the way you really make money in the markets is by buying low. And you can't buy low unless you sell high. 95% of all people can't do that. So that feeds right into his investment philosophy, and he's one of the, best investors ever. So, it's hard not to agree with that.
Bob, how can people find out more about your newsletter and your book?
They can go to my website, which is realestatetiming.com, realestatetiming.com, just like it sounds, no dots or spaces of that. And you can, I have my book for sale. I'm on, that's been published now for 16 years. And it's really good. It tells you how everything that I do. My timing letter's on there. I time 20 or 25 markets in the United States, none anywhere else. But that's, for those of you that are interested in real estate and real estate trends, I kind of consider myself, I don't think there's anybody in the world that does this better than myself. So it's a real good source of knowing what the trends are doing, at least here in the United States.
Bob, thanks a lot for chatting with us.
Nice talking to you again, Jim. Look forward to talking to you again real soon.
My guest has been Robert Campbell, author of Timing the Real Estate Market, his website, realestatetiming.com. He was speaking to us from San Diego. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Eric Hadik, and Robert Campbell. And thank you for listening. If you have any questions for our guests or the show, you can send them to info@howstreet.com. Now stand by for a company showcase update from Larry Reaugh, the CEO and president of American Manganese. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Larry Ray, CEO and President of American Manganese. Welcome back to the show, Larry.
It's always good to be on the show, Jim.
Is American Manganese going to be at the Cambridge House Show?
Yes, we certainly are. As a matter of fact, I will be presenting the company at that show, and I will be sitting on a 30-minute panel. And I expect the company will have good exposure. We do have a booth that's 502, which we'll be manning. And I've already got about, 7 or 8 meetings set up with various funds and brokerages that will take place at that show, and it's on September 19th and 20th. This is, to me, it's a very important investor show. It looks to me like there's quite a few companies with technologies that will be represented at that show. I think it's something like 50. And so we fit in there. It's of course, in the usual mining participants. And we fit in there too. So it's going to be an exciting show for the company. We'll be down there representing the recycling opportunity the company has. And, it's really going to be kind of an eye-opener for, within Vancouver area and certainly within the province. So I'm looking forward to it, Jim. And, another point, I've been following the Apple innovation environmental issues and following what Lisa Jackson, the environmental spokesperson for Apple, has had to say. And they're talking about Liam, the old recycling robot that used to take the iPhone apart. You could go on Google and see that. Now they have a new robotic disassembler, and that is Daisy. And I think they can do 200 iPhones an hour on that. But what that tells me is that they definitely want to recycle their materials. They certainly are taking the mechanical parts of the iPhone apart, but it's the battery that remains the biggest problem. And what has happened over the years is the battery for your iPhones and for your handheld devices and tablets that used to be able to take them out and replace them. You can't do that anymore. They're embedded in the design, and it makes it very difficult to discharge them and get them out. It can take a half hour, 40 minutes to get a battery out of a phone. Maybe you can do that robotically a lot faster. But, there's heat involved with glues and everything else on disassembling these batteries. And we certainly want to have a market in those because the battery has a very high cobalt content. I think we said at one time that Apple actually uses about $350 million worth of cathode materials a year, and that's a big component of cobalt. So we're, sitting on the sidelines, hoping that Apple will develop a method of actually taking that battery out and getting the foils, and which would be ideal for our metallurgical process for getting the cathode materials out. So there's lots of opportunities out there that the company can see. You think of Apple, Samsung, and all those companies that have those devices. There's a lot of cobalt tied up in that chain. But you go back to the EV car chain, we're looking at disassembly of the batteries. It's a little easier than than iPhones or anything like that, because they're all, around thumb size. And you should be able to make a disassembly process that will work on all different shapes and sizes of cylindrical batteries. And that gets you down to the foils. And currently we've been testing the foils that we received, and we're getting good results from those. So this is all moving things forward for us, Jim. It's interesting. I bring up the Apple process because we have the tail end of the answer for them. And they certainly were looking at ways to get at those cell phone batteries, and certainly at the tablets and all those types of batteries, which are usually pretty thin and glued into place within the tablet or the phone itself. So we recognize that that's a problem. We're happy to see that Apple is actually working on that problem, and that a lot of stuff that they're also, taking back batteries and reusing them if they have, and paying you a small amount of money, and if not, they go into the disassembly process, and that has to happen. And really, what you have to see even in the EV car industry is that you have to see a standardization of how you deal with those batteries so that they can be recycled. And it's been easier to glue things together and have them all in a pack that makes it a lot more difficult to discharge and to get the glues off, because you have to get those off before it can be disassembled. But it's progress that's being made, and we want to be a part of that. And we'll be discussing that at the show. If anybody was to say, well, what are you going to do with all that power you're discharging? Well, there's got to be a way of putting that back into the system, and we'll certainly want to do that, because we want to be a total circular economy. We don't want to be throwing out the baby with the bathwater, and so we recognize the challenges that are ahead of us, and we're only too happy to keep working them down.
Larry, for people who are new to your company, can you tell us what American Manganese does and what you hope to do?
American Manganese has taken a technology it developed almost 10 years ago that for manganese, and adapted and changed that technology to recycle, metallurgically recycle the cathode materials out of batteries. And we've had great success. We've had 100% recoveries of those cathode materials. We're moving ahead with our process for the pilot plant, and we're still waiting for a few parts for that. But we also expect any day to get about a ton of foil material from a scrap dealer in the U.S., and we're going to put that through the pilot plant over a period of time. Should be able to get about reclaim maybe 2 kilograms, 2 kilos an hour, I'd hope, but it may be less than that. Maybe it's 1 kilo. And that's kind of what we're doing. We're moving ahead. Our patent is pending, and it's been published, so we're well advanced.
Larry, where are you traded, and where can people find out more information?
We're traded on the TSX Venture Exchange, which under the symbol AMY. We're traded on in the U.S. under the symbol AMYZF, and in Frankfurt, Germany under the symbol 2AM. People can go to our site. We keep everything on that site, including business plans and all press releases, anything that's germane to the market. They can go to the site and investigate us. They can also phone me at 778-574-4444, or they can email me at lreaugh@amymn.com.
Larry, thanks for talking with us.
Thank you.
I've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on September 14th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.